Mike Tedeschi, Wealth Management Advisor over at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We're going to take a look at the value of the U.S. stock market against the world's GDP, and we're going to take a look in at oil. Also take a look at gold, silver, and the huge move out of the precious metal space this week, and we'll check back in with the U.S. dollar as well. Let's jump right into it. I have the chart of the S&P 500 up, and we are just a stone's throw away from those all-time highs. Almost got them earlier this week, just under them at the moment. This would be an area where the bulls really do not want to see the market fail, as if we were to fail right here, we would be putting in a potential double top. So we really want to see stocks break above that zone and hold over it here in the near future. This gap from February here finally was closed. So really the last part of resistance is that all-time high zone that's right up here. And so we're going to be watching this zone very closely in on the S&P 500. Now, the Dow Jones Industrial Average still well below those all-time highs and has not closed the gap from February. If we zoom in here and we take a look, this line and this line right here is the gap from back in February, and we have not even gotten up to it yet. So bulls really want to see the Dow get into this gap zone and continue to push higher. Again, if the S&P were to fail here and the Dow were to fail here, the S&P would have that double top and the Dow would fail right at this resistance zone from that gap down. So that would not be a good time for stocks to fail to continue to push higher. The Russell has had a very strong week last week. We touched on that. It's pulled up and it started to make a base. The resistance zone really starts right in here at about that 1600 and goes up to about 1620. That is that zone from February as well. That's this resistance zone right in here. This also would not be a good place to see a failure there out of the Russell. You really kind of want to get back up over that 1620 zone, and then that would give us that potential run back to that 1700 all-time high area. Now, of course, the Nasdaq has been the leader, continues to be the leader, almost at new all-time highs once again. Had a little bit of a dip last week. All it did was close that gap up and then subsequently held right there and has continued to push higher. We'll continue to watch for a new all-time high to get made, but this has continued its channel trading higher here now really since April and has been extremely strong the entire time and has no real technical weakness, so to speak of. So we're going to continue to pay attention over there. Now, last week we looked in at the U.S. dollar, and we looked in at the commodities as well, and what we've got forming in on a daily chart is really a potential bear flag. All right, so we have a move down here, and then you can see this bear flag, and we break lower, and here we have that same type of setup. So if we take out the lows put in a week or so ago, that really does set that 91 zone up there on the U.S. dollar. So we're watching this zone really, really carefully to see if we have any more continued weakness. Now, when we talk about the U.S. dollar, we talk about the weaker the dollar is, that would be a tailwind for most of the commodities. Well, let's look into the commodity space this week. First, we'll take a look at oil. Oil has broken above that gap zone, and we talked about this last week. Right in here, it is broken above it, but it hasn't really gone anywhere. You can see it's basically just traded right there. Volatility has kind of disappeared in oil here for the last actually month or so. It's been a very, very tight, small kind of grind higher. You really would like to see this next push up to get away from this gap zone to really confirm this breakout. Trading just right there on that level doesn't make me super confident that this is necessarily going to hold. It is trading above that zone, but it doesn't take much of an effort to get it back underneath that gap and back towards that 35 zone. So really watching the oil space, we want to see that continue to push higher here, or there's a little bit of concern. Now, we had an incredible move out of gold and silver here this week, and we're actually going to take a look at some data points as well on gold in a moment. But this was one heck of a daily drop that happened in the precious metal space earlier this week. Gold going from $20.50 an ounce all the way down to $19.20 an ounce, lost more than $100 an ounce, and undid about 2 weeks worth of upward movement there in the course of one session. However, it did not break back below the important 1825 level that we were watching for a while, and did put in a nice kind of reversal potential wick and is holding up above that zone here today. So we haven't had a major breakdown from the charting perspective, but that was certainly one shot across the bow there out of the precious metals space. The same thing happened in silver as well. Silver went from almost $30 an ounce and fell off a cliff and fell all the way back to 25. And you can see the importance of that 25 zone. Did break a little bit below them, but closed above it and continues to push back up. So it did not lose the important 26 level so far on a weekly closing basis. But again, a big shot across the bow there out of the silver as well. Now, when we take a look at the optimism in gold, it had been exceedingly high, and this was one of the concerns for the precious metal space, that we may have gotten ahead of ourselves in the short term with really seeing lots of articles posting about gold, how it's over $2,000 an ounce, and it's going to go to 3 and 4 and 5,000. And when you have optimism that's so high, remember, there's only so many people that subsequently can buy something. And once everybody that's kind of in on it, it doesn't take much pressure to actually turn something and flip the other direction. Well, if everybody had chased that kind of move up here over the last couple of weeks, as we could kind of see in that optics, a pullback would be healthy for a longer-term move. And we had the largest one-day drop in 30 years in the gold optimism index, which you'll see fell right back to kind of that important 60 zone in there on this chart, which kind of lets that rubber band, which was really stretched, kind of come back down and give us the ability to maybe see another push back up. So on a optimism level, that pullback earlier this week may have been very beneficial for a longer term, but usually when you see a drop like this, it actually does cause some pain in the short term. Let's look at the actual numbers. Now, when we look at these numbers, you can see here a week, 2 weeks, a month later, 2 months later, and all the way out to 3 months later, you actually have a negative skew for the price of gold when it cycles from an over 80 to an under 80 in less than 10 days. But you'll also notice this happened a lot on the way up. If you notice that between 2002 and 2012. Right, so there are little cool-off periods before that next kind of push higher. And so we get 6 months and a year later, we're positive more than 50% of the time. And if you actually look at this data 2 years later, you'd have an even higher positive percentage. So again, in the short term, that might be a little bit of a concern. We may have to build a little bit of a sideways base for some time. But long term, that hasn't necessarily been a bad thing. Now, the last thing I wanted to touch on was the value of U.S. stocks against the global GDP. And we don't have a ton of data points in here. This has happened essentially 3 times where we've basically been at that or above that 40% zone in terms of the U.S. stocks as a percentage of the world's GDP. All of them marked major underperformance for the U.S. versus the world moving forward in the past. It's 2 for 2, so again, not a ton of data points. But this is a bit of a concern when you really think about it, that the value of the U.S. stocks are almost approaching that 50% of total global GDP. So this, again, gives us that idea, and when we take a look at this number, and I mentioned this before, the emerging markets are becoming more and more interesting to me, especially with a weak dollar that's usually putting a tailwind in. And this data set's showing us that, perhaps the rest of the world needs to start catching up to the valuations that we've seen here in the U.S. So if the dollar continues to stay weak, the emerging markets may get a bit of a boom from this. As always, guys, if you want to reach out to me directly, if you've got any questions with markets, or you want to talk anything stocks, please reach out at mtesky@perspectivewealthplanning.com or give me a call at 814-580-9881. Hopefully this information was useful, and as always, I will see you guys next week.